Hey everyone, this is Addy from Scaled. Today I'm going to talk about high probability option setups, the trades that I normally look at. I've seen people chase complicated setups. They look at 5 different indicators on their charts. They have so many things going on in their setups. It's just complicated to look at a screen and figure out whether this is a good trade or a bad trade. Now, I used to do the same thing when I first started in options trading. I used to buy options, and then I probably had 15 different things going on before I would enter the trade. And then guess what? That trade would be, from the word get go, it would be against me, meaning the probability of winning in that trade would be against me because I was buying options at the wrong time, wrong setups. It was just really hard to time the market. Buying options means you have to time the market, meaning only if the market goes in your favor within that time period, you make money. Otherwise, you will lose the debit that you will pay to buy the options. So the idea is to sell that option and move the probability of winning in your favor. What I mean by that is we sell a credit spread to begin with. You have to make sure you're getting into liquid underlyings, you're picking the right strike, the right delta, and the right underlying ticker, and all that liquidity stuff and volume that I look at before I enter the trade. Now let me take you through a quick example, a live trade of what I do normally to pick a high probability trade, around 80% probability of profit in my favor, and only 20% in the buyer's favor. So I'm selling this option, and then buyer is the buying the option, meaning I'm to make 80% to make a profit in this trade 80% of the time, and the buyer is only to make profit 20% of the time. Yes, their profit is high, will be higher. It can go through the moon, but the chances and the probability of that happening is 2 out of 10. 8 out of 10, it will be me who will win in this trade. And don't get me wrong, we always see losing trades in our style of trading as well, where we sell a 17 to 20 delta strike, and then we buy something else, create a risk-defined strategy. But based on math, we are supposed to win at least 70% of the time or more. So how do I do that? It's a quick video to show you what to look at before getting confused with everything. Even if you look at my screen right now, I don't have much going on. It's a price chart. I have some indicator moving EMA moving averages, and I've based it off of 32 days. I need to change that because I sell 45-day cycles. There are 32 to 33 days within that cycle, trading days. And then on the bottom here, I have just implied volatility. And this is the simple setup I have. I have no other indicators going on, and I take my trades through this. And trust me, I've been successful winning the trades more often than losing those trades. And my P&L last year was pretty good. I was up about 15, 17% on my account. This year, I got hurt in April, to be very honest, because I was in some trades and then the markets fell down on me. And it was a defensive mode since then. So I haven't really recovered on those trades yet, but I keep making new ones to distribute the P&L to lower the volatility of the P&L of the overall account. This is my paper trading account. So the fills are not real, and the commissions that we pay here are not real either. But I will show you that on the next screen. So let's go through an example so you can probably take a look at this on your own screen. What am I looking at? Apple. First of all, equities and ETFs are my not my go-to options. My go-to underlying markets are basically futures options. If you look at on this side here on the left, from top to bottom, I have the futures options indicators first. All these. I have the futures options indicators first. In my real account, I have a slightly better watch list, and I can share that with you all. But right now, this covers everything that we look at. So we have 10 to 15 tickers here involved that we can trade, very liquid markets. And because the capital efficiency that you get from futures options is completely different, it's 3 times better. And I will show you that right now. By that, what I mean is if you would apply the same logic to an equity or an ETF trade, your capital allocation or your capital efficiency will go down 3 times. And let's take a look at that right now. So a go-to market in Apple, if I were to trade where is Apple trading right now? Equities are at all-time highs, almost all-time highs. Apple traded at 260. First of all, I would not trade this stock right now. But if I were to trade and compare apples to apples with a real trade that I would take in a futures options market, this is what I would have done here. I would have sold a 18 delta strike, right click, sell vertical, right? Sell a vertical and then go back. So I'm selling it at 215 strike and I'm buying, I would have taken the $10 wide strike. So 205 is my buy point. Where is 205 trading? It's at 10 delta. Okay, totally fine. So I'm selling at 18, buying it at 10. And then I would have traded one contract. That's my go-to to enter the trade or start a position, right? And let me show you everything that I normally look at. But remember, this is not what I would do if I were to take a trade today. I would go in the futures options market and do something there, and I will show you that next. This is for comparison. So our expiration is on 10/18. So 10/18. Pick 10/18 from here, top left, top right here. 10/18 is this date, and then you will get the right chart. The probability of profit in both trades will be similar because you're trading the exact same methodology. I'm showing you this for capital efficiency. What can you get for your same amount of dollars in this market versus a futures options market to make the same amount of money? Keep an eye on that. Now, let's take a look at the delta. So the deltas are, that's not the right one. Let's take a look at -10 plus 10 to give you this bottom line, this middle line. This is the line that we need to look at because this is where the underlying is trading. $232. So this is the line we have to focus on. We collect some positive delta because we're selling puts, some positive theta, negative short vol, and then the P&L open is 0. Now let's look at this. We are making $1.10, which is totally fine. $110 in options world. And if I were to compare, confirm, and send this trade, I'm putting down $890 to kickstart this trade. In order to make, let's say, round it up to 100, I'm putting down $900, right? So that's the risk reward here. You're putting down 100 to collect, sorry, you're putting down 900 to collect 100. So the ratio is 9 to 1. Your max loss is $1,000 here. Sorry, max loss is 900 if you're collecting $100 because you will keep that premium in your pocket. Now, let's look at leave this Apple trade there. Let's look at the /ES market. The markets are down 50 points. Great day to sell some puts. As a contrarian, I would go and sell into the strength of the market, meaning if the market is down, I would sell puts. If the market is up, I would sell calls. But I do refrain from selling calls in the major indices, S&P, NASDAQ, Russell, and the Dow Jones. Because those, you can look at the chart here, most of the people are buyers of these indices and in these markets. So it usually goes top right. So we don't want to be selling calls here. So keep that in mind. Let's try and do a put spread here. The same thing. 49 days out, same cycle. We were able to pick the same cycle. Look at the liquidity and open interest here as well. It's in thousands. And you would see the same thing in the Apple market as well. So I'm looking at open interest in thousands. Apple would be the same. What is the volatility right now? Implied vol ticked up, not really that much, but it's at the bottom. So we need to be careful here when you sell at the bottom. I would never enter this trade here, but I would enter it when the volatility jumps up. It's because you look at the vol product, right? Volatility is the only mean reverting asset in these markets. Whenever it pops up, it comes back down to its mean level. Now, its mean level does not really change. It stays at 15 to 14, 16 level. So whenever it pops up, you know that this thing will always come down. So you should sell this, right? Because if it's at the top and you know it's going to go down, you should sell that product. The only problem here is, it's not a problem, but you need to keep an eye on it, is when it goes up, how far up can it go before it peaks out and then it drops? That's something that we don't know, and we will never know. So we do the trades as the market provides the opportunity. We keep an eye on all these things, but whenever volatility pops up, we do become aggressive sellers of volatility and the markets. But I do it in a risk-defined manner. So I don't leave the risk open on both sides. I don't sell triangles, I don't sell straddles or anything else. I would go in as a risk-defined strategy, meaning it's something that I have worked on really well, back tested, and it works well for me in my mind for my sleep. I can sleep better if I have the risk defined in these trades. Let's take a look at the trade. Go in here, pick up the same delta at 61.50. And in this market, you have to go 20 point wide in order to collect the same amount of credit, because that's how it works. It's tick size based, which I will talk about later. But in order to do apples to apples comparison, you have to pick a $20 wide spread here. So I'm selling at 61.50. I'm going to buy it back at 61.30. Okay. So I'm selling at 18, buying it back at, oh, sorry, 25 points wide, because there's no 20 points wide available. So I have to go 25 points wide, which is fine. This is what I normally do, actually. 25 points wide, not 20. 20 is in a different market, gold somewhere else, euro, the British pound. Now let's look at the trade here. There you go. Okay. We need to fix our, why is the chart not coming up? It's worth, let's choose 1018. Where's my chart? Take this off again. Let's go back, bring it back in. Nice. There you go. Okay, so set slices at break even first, 1018, same thing. Now look, you get an even better, well, it's not really that better, but it is somewhat similar, right? So 80% pop in the Apple trade, 80% pop here, completely apples to apples, right? You have a similar probability of profit on both sides. Now look at this. So it's trading at 275. This is how much I normally collect in this kind of trade. It can go up to 325, 350, or sometimes, which is the max I've sold it at. But usually when the volatility is so low, this is how much you will collect: 275 or max three points, which will be $150 in this futures options world. Now, what's the max profit? Max profit is $137, so slightly better than the Apple trade. The max loss is slightly worse than Apple trade, so over there was 900. Here it's about 1,112 minus the credit that you collect, so 137. So almost there, similar apples to apples. Now look at the if I confirm and send, look at the amount of money I'm paying down, $430 to initiate that trade. I was paying down $900 there, so that's 2 to 1 ratio. Now in indices, you usually pay more to initiate that trade, the similar trade. But in commodities, in gold, in silver, in oil, in other markets, in euros, especially currency markets, this number would be $300. And if you don't believe me, let's take a look at this right now. If I were to do the same, so we saw the similarity here for the same amount of money. Now the question is, oh, I'm not getting a one-for-one Apple exposure or selling an Apple spread compared to here. The goal is to make money wherever the opportunity is. There is no opportunity in Apple right now, but if there was one, you could have probably taken that trade. I would not. I would still go into the NASDAQ market and sell the NASDAQ index in the futures options, collect same amount of money, and diversify my risk. Individual equities volatility is higher than the overall index because the overall index has a bunch of other things in there. So the volatility seems to stay around these numbers. For S&P 500, it's around 16, 17 right now, 15. And if you were to do the same trade in oil or any other currency market, this number initial amount would have been $300. So that's the major difference on capital efficiency. So today's video was all around finding high probability trades, option setups. And this is one of them, the credit spread. I've shown you the put spread. In the next video, I will show you the call spread side. There's really good markets to sell the call side as well, meaning you are shorting the market. Here you're going long the market, but on the call side, you will short that market. So keep that in mind. And I will put all the links in the video. One thing I wanted to show you guys is I do run a 5-day trading challenge where I discuss all these things. Go on this website. I'll put the link in the description. Email me if you have any questions. Go down here, and we don't have the live dates yet, but this page will be updated for the next cohort, which will start in 15-20 days. And pick this email, drop me an email if you have any questions, or drop me a comment on this video on YouTube. Bye-bye. Thank you very much.